unreimbursed employee business expenses. These are actually paid or business expenses, but they are reported below the line with our more personal and investment-related expenses. Okay, so that's our one exception. Okay, we're just going to kind of go right down the list here. So we're going to start with the medical expenses, and actually on the form you'll see it says medical and dental expenses. Okay, we're looking to see what is qualified. Guys, you can deduct unreimbursed expenses. Obviously, if you receive some sort of reimbursement, you can't double it and take it as a deduction. Okay, so you have to subtract off any money you get back before you put together your list of qualifying expenses. The code says, guys, that you can take deductions for yourself, your spouse, and any of your dependents, okay, for medical or dental. And it reads like this. You can deduct expenses for purposes of treatment, prevention, diagnosis, cure, and mitigation of diseases affecting any structure or function of the body. You do not have to write that down and know that. The point being, it's a very broad statement, okay? They're encompassing a lot of different sorts of medical treatments. So what's included in this specifically, okay? Look, guys, hopefully most of us have health insurance, okay? If your employer provides you with health insurance, that's his expense, right? He can deduct it, and it's a tax-free fringe for you. Now, a lot of us go out to work, and actually our employer may pay half of our insurance, and we have to pay the other half of our insurance, and that's going to come directly out of your paycheck. Now, in most cases, guys, that's going to come from pre-tax dollars, and because you're deducting that with the pre-tax dollars, you can't include those premiums you pay in this qualified medical expenses. However, if you're not getting employer insurance, and maybe you have to go out and purchase it on your own, and you're paying with it with post-tax dollars, that's going to qualify. You can include that on your list of qualifying medical expenses. The same if you have Medicare, if you have to purchase Medicare, that's a qualifying medical expense. Okay, and last week when we were doing our 4 AGI deductions, right, we talked about our self-employed taxpayer who wasn't allowed to deduct his own medical costs that he bought for himself on his Schedule C. He can deduct them right up to his net profit as 4 AGI, but his other alternative, guys, is to bring those down below the line as an itemized deduction. So a self-employed taxpayer purchasing his own insurance could include these in the qualified medical expenses, okay? Now, guys, insurance hopefully covers most of our expenses, but, you know, a lot of times you have co-pays. You go to the doctor, you have to pay $20, $30, $50 just to kind of walk in the office. That would be a qualifying medical expense. A lot of times also now insurance is, you know, kind of getting less and less. A lot of times now there's out-of-pocket expenses above and beyond the copay. Okay, those are qualifying medical expenses. They're not being covered by your insurance, so they qualify. More specifically, guys, I mean, look, hospital fees, that's going to count. Prescription drugs, okay, prescription, something your doctor specifically sends to the pharmacy or requests for you. That's going to count as a qualifying medical expense. Guys, things like glasses, eyeglasses, of course, any sort of dental work, hearing aids, wheelchairs, okay, any sort of handicap devices are all going to count. Rehabilitation, okay, that will count. You have a surgery and then the doctor orders you to go to rehab. Rehab will count. What is not included, okay, this is probably the easier way to remember this, guys, over-the-counter drugs, okay, OTC drugs. You go to the store, you pick up some Tylenol, some Sudafed, things of that nature. Those are not qualifying medical expenses. Those are your personal expense. Most forms of cosmetic surgery.
Do braces count as cosmetic surgery?
They're generally going to be cosmetic. Yeah, unless, there's some sort of medical need, they have to realign, something in your mouth. But for the most part, they're considered cosmetic. And I know because my daughter's going to get those. Okay. So most cosmetic surgery, guys. The book lists a few situations where maybe cosmetic surgery would in fact qualify. Certain deformities, or you're involved in a car accident and they're going to rebuild something. Yes, it's cosmetic, but in that case, they would allow it to be qualified. Something like a gym membership, a lot of people will say, wait, it's for the prevention of my health, I'm being preventative, okay, but gym memberships do not count, okay, they're not a qualifying medical expense. The book lists out, guys, that if you have to travel for essential medical care, okay, certain costs are in fact going to qualify, okay? As far as travel goes, if you have to stay in a hotel, they allow you to deduct up to $50 a night, okay? Hotel stays for medical, you can take $50 a night. If you use your car, the mileage rate this year is 23 cents a mile, so you're driving back and forth. Like I have a friend whose son goes to a doctor repeatedly down to Philly, who sees a specialist down there. She's constantly driving back and forth and racking the miles up in her car. She can deduct 23 cents a mile for the use of her car. You know, guys, if you had to fly, honestly, you need to see some sort of specialist who, you know, is in Arizona. I mean, you could theoretically deduct the cost of your plane ticket if you have to go see this person, okay? Things like hospital stays, okay? Hospital stays, look, part of the bill includes lodging and meals, and typically the Internal Revenue Code considers things like lodging and meals personal in nature. But when it comes to a hospital bill, they have said, okay, the entire bill is a qualifying medical expense. So that's one of the exceptions, okay? Your entire hospital bill will be a qualifying medical expense. But if you stay in other facilities, okay, you have to look more carefully at the bill. And I'm talking about things like an assisted living or a hospice, okay? The general rule here says if your primary reason for staying at these other types of facilities is medical in nature, then you can deduct the medical portion. But you're gonna have to pull out the meals and the lodging, okay? So again, if you're there primarily for medical, the medical portion of the bill is qualifying medical expense. But they're gonna have to allocate to you what portion is meals, what portion is lodging. That is your personal expense. Sorry, I'm getting this completely backwards. If its primary purpose is the stay, it's all gonna be deductible. If you're primarily there for medical reasons, okay, it's all deductible. I totally screwed you up, sorry.
So lodging and meals are deductible?
Yes, yes. If you're not primarily there for the purpose of medical reasons, okay, maybe you put grandma in an assisted living. And grandma really, for the most part, is pretty healthy, okay? You're really just putting her there because, you know, there's some social activities, and there's people about that if something does happen, there's people routinely about who can check in on her and like that. But for the most part, you know, grandma is well, she's self-sufficient, she can take care of herself. She's staying in an assisted living, okay? In that case, guys, if there is a medical portion of the bill, that would be deductible. But for the most part, she's really just living there, okay? So her lodging, her meals, in that sort of case, would not be deductible, okay? But let's just say, grandpa, on the other hand, maybe he has severe Alzheimer's, okay? Now you're putting him in assisted living, really because he can't take care of himself, all right? He needs nurses, he needs doctor care, you know, pretty much monitored around the clock. In that case, grandpa's entire assisted living bill would be deductible, okay? Something like hospice, guys, that's gonna be fully deductible, okay? Sorry, I didn't mean to screw you all. Okay. What's not in the book, okay, take note if you're not paying attention. What's not in the book, guys, are taxpayers sometimes make capital improvements to their homes for medical reasons, okay? They may do, you know, put in pools, they could do all sorts of different things. You know, build ramps for someone who's handicapped, okay? And it's a significant expense, and really it's a capital expenditure. And in that case, what the rule says is that they can deduct those costs to the extent that the increase in the fair market value of the home is taken into account, okay? So just a very simple example, let's just say for medical reasons, someone has to install a pool. And there's actually court cases where this has happened. People have installed pools in their yards for medical related reasons. So let's just say it costs $30,000, okay? And because they put that pool in, their fair market value of their house was $250,000, but with the addition of the pool, it jumped up to $260,000, a $10,000 increase, right? The rule here says that, look, they can take the cost of this pool, this medically qualifying pool, and deduct it after the difference of the fair market value of the home, okay? So it cost them $30,000, but the home increased by 10, so they're getting a benefit for that. So they can deduct the $20,000 difference, okay? Okay, guys, I'm gonna remind you, we are talking about individuals, so we are talking about cash basis taxpayers, okay? It depends on when did you pay these expenses. We don't care about when they incurred. It depends on when did you fork over the cash, when did you write the check, when did you give them the credit card to process the payment, okay? That's what you're focused on. You deduct an expense when you pay it. You don't worry about the year that it was incurred for. So if I paid a hospital bill this year, even though my son was in the hospital last year, I take the deduction in 2015, not in 2014 when the bill was for. Okay, be focused on, again, we are cash basis taxpayers. When did you pay these bills? That's when you take the deduction. Okay. Now the idea is this, guys. So you may have a whole bunch of medical expenses, okay? Now you need to go through the list of expenses and pull out anything that's not qualifying, okay? Take anything off the list. And then come up with a grand total of your qualifying expenses, okay? But you're not done because there's limitations here, okay? The rules go on to say that if you're under 65 years of age, okay, you have to apply a 10% floor. You take your AGI, okay, which we learned how to calculate, and you multiply it by 10%. Any expenses up to that 10% number, guys, you throw out. They're not deductible. Only the expenses that make it over that 10% figure, okay, over this 10% hurdle, those are going to be deductible on your Schedule A. That's what you're going to end up reporting, okay? Now, if you're 65 or older, guys, that rate drops to 7.5%. 65 or older. I checked that problem, by the way. I think you guys read it wrong.
Yeah, I did. I went back.
I went to look, I was like, and then it said under 65.
Yeah.
So if you're 65 or older, the rate becomes 7.5% instead. Guys, in an exam, if you start seeing people's ages, pay attention to the ages, okay? Because it probably means something. And we're going to have a few of these things where ages are going to play a role in determining what rates you can use, okay? By the way, if you're married filing joint, guys, only one of the taxpayers has to be 65. So you can have a 65-year-old male married to a 43-year-old woman. As long as one of them is 65, the 7.5 is going to apply to that joint return, okay? So look, I mean, in general, guys, this is, it's a pretty high hurdle, okay? You have to have a lot of medical expenses, or you have to have a sort of a low AGI before most people are going to be able to take this sort of deduction. Just a very simple example, let's just say we have a single taxpayer who's under 65, okay? He's got qualified medical expenses, so he's already gone in and pulled out, any OTC drugs, any cosmetic surgery, anything that's not going to meet this definition. And he has an AGI of $50,000, okay? You take the qualifying expenses, guys, you apply the floor, okay? His AGI is $50,000. He's under 65, so you're going to multiply it by 10%. That means the first $5,000 of expenses, like I said, you throw them out the window. They're no good to him, okay? Only the $1,625, those expenses that make it over that hurdle, this is what's going to get reported on the Schedule A. This is going to be your deductible expense, okay? Guys, same problem, but let's just assume he got some money back from the insurance company, right? He initially paid the doctor, but insurance returned some money to him later in the year, okay? Same qualifying medical expenses. Make sure you take out any reimbursement first. Again, if you get money back, you can't double dip and also take a reduction. So really, he has to reduce his qualifying medical expenses in that case to $5,175. You go in, you apply his floor, okay? And only the difference, $175 in that case, is what's going to get shown on your Schedule A. Guys, again, be careful. You see a problem where the taxpayer is 65 or over, that 10% becomes 7.5%, okay? That's medical. The next itemized deduction, if you look at your list, guys, is taxes you paid, okay? And there are 3 types of taxes that qualify for deduction. And there's no limitations, really, in this case. There's no percentage or floor limitations of any sort, okay? The first one is state, local, and foreign income taxes. Guys, income taxes. State, local, foreign. Notice there's no deduction here for federal income taxes. Those are not deductible, not on your federal return, okay? what I'm gonna stop and point out here, guys, is when we did gross income, we talked about the foreign earned income exclusion. We said a taxpayer can exclude $100,800 from his earned forms of income that he earns overseas, okay? That was one option. Instead of taking that option, this would be a second option, okay? So he wouldn't be able to do both. He wouldn't be able to exclude the $100,800 and take this first option. He would be able to do one or the other in the case of foreign income taxes, okay? But this is your first item. So you can deduct state, local, foreign income taxes, okay? The second one is real estate taxes, guys. You know, if you own a home, you get a property tax bill, okay? You can deduct it. You can deduct it. And this is for personal or investment property taxes, guys. If you have a property tax bill related to your trade or business, that's going to get deducted on your Schedule C, okay? So down here below the line, this is only personal and investment property taxes, okay? And this is real estate taxes, really. The third category are personal property taxes, okay? This is not real estate, this is personal property taxes. I said some, we talked about this I think in chapter 1, that some states have personal taxes. But these are very specifically, you can deduct them if they're on the value of the personal property, okay? So some states may charge taxes on, like, you know, cars, but they may do it on the number of axles on the car or the truck. They may do it on the weight, okay? Those wouldn't qualify. It very specifically has to be on the value, okay? So be careful. Now, for number 1, where I said state, local, and foreign income taxes are deductible, you have an option, okay? Instead of deducting your state or local income taxes, guys, you could opt to deduct your state or local sales taxes instead, okay? Why would you want to do this? Not every state has an income tax, okay? States like Florida, Texas, there's no income tax. So there, it may make sense to keep track of what you purchased, and then instead you're going to deduct your sales taxes, okay? And then again, we're cash basis taxpayers, so you have to be paying attention to when did I pay the tax, not what year am I paying the tax for, okay? To give you some examples, right, on April 15th, we know we all have to pay our, file and pay our tax returns for the prior year. But even though I'm paying my taxes in 2015 for 2014, that payment that I made in 2015 gets deducted on the 2015 return, okay? Despite the fact that I'm taking it for the 2014 return. You pay it in the year, or you deduct it in the year you pay it. What else is counted in here? Income taxes withheld by your employer, right? You go to work, they withhold federal, they withhold state income taxes from your paycheck, okay? In the year they're doing the withholding is the year that counts towards being paid.
I have a question. You said state income tax is deductible. For like a lot of sports players, they'll make a point where they'll go to like Florida or Texas because there's no state income tax, but what's the difference on if the income tax is deductible anyways?
Well, this is for federal. This is on your federal return. They still would have to file, like here in New Jersey, you file a federal return, but you also file and have to pay New Jersey state taxes. They're really only going to have to file a federal return. A lot of states will go after them anyway, though, because they play their games all over the country, and they're, earning money, like golf players. They go to tournaments in all different states, and they're earning millions of dollars in various places. States will usually try and find a way to go after them. And you have to establish that that's truly your residence. It doesn't always work. But yeah, if truly they could establish their residence, in Florida, they owe no taxes, so they can earn $5 million, but they don't owe a dime on it. So that's how we want to do it. A lot of tennis players, I know they have residences in like Monaco because there's no taxes. Okay. So income taxes, guys, if you have withholdings being done by your employer for income taxes, okay, when they're withholding them is when you deduct them, the year you deduct them in. Same for estimated taxes. You make estimated tax payments, again, when did you write the check? Now, I might have filed my 2014 return in April, and maybe I'm due a refund, okay? And technically, I should get that refund and a check this year, 2015, for my 2014 return. Okay, but I may say to them, you know what, keep it, apply it to my 2015 return. In that case, the deduction counts in 2015, because it's kind of like I had them give me the cash and then I gave it back to them for 2015, okay? So just be careful of, when are you paying it? Don't be fooled by, oh, it's for the 2014 return or the 2013 return. Look at the cash, okay? Interest, okay? That's our next deduction. Guys, the general rule with interest as far as individuals go is that it's not deductible, okay? That's the general overall rule if you're an individual, okay? It's not deductible, but, okay, there's always exceptions. We've already looked at one, right? We already looked at the qualifying education, the interest on the loans, okay? The 4 AGI deduction up to $2,500. Well, that's one exception, okay? We are going to look at another exception in Chapter 7 when we get there on investment expenses, okay? We can deduct certain interest for investment expenses. And the last one that we're going to look at right now is mortgage interest, okay, guys? It's going to be related to your home. And there's two types. There's what's called acquisition indebtedness, and there's what's called home equity indebtedness, and each has its own rule, okay? Guys, the book refers to this as acquisition indebtedness. It's debt that's secured by your home, the main residence, okay? And it is used to purchase the home, to construct the home if it doesn't exist, or substantially improve the home, okay? But it's used specifically for those purposes secured by the home. Guys, for the most of us, this is gonna be our mortgage, okay? Our main mortgage, okay? In the case of home equity, okay, look, this is a loan you take out, and it's secured by your residence, but you can use this loan for any reason. You don't have to use it for purposes of the home. You could take it out, and you can use it to buy a car. You can go out and go shopping at the mall with it.
Secured by your residence, you mean like your residence is the collateral?
Collateral, right. If you don't pay it, they're gonna go after the home. Yeah. So with the home equity, guys, it's different because, like I said, you don't have to use the proceeds towards the home in any way. You can use them for whatever you want. Now, I will make the point, right, guys, when we talked about the qualified education interest deductions, we did say in that particular case that if you take the home equity and you use it for the education, you can't take the interest deduction if it's coming from a home equity, okay? You could take the interest here as a deduction, but you wouldn't be able to use it as that 4 AGI deduction, okay? So just take note of that. A home equity, if you use it for education, you could take it here below the line, any interest you pay, okay? But you can't use a home equity towards the above the line 4 AGI interest deduction that we talked about last week. Okay. Now they have different limitations. The acquisition, the mortgage debt, guys, says you could deduct interest on any amount up to $1 million of loans, okay? So you can take any amount of interest on up to $1 million of mortgage debt. And we'll go through an example. Okay, that's for the acquisition portion of it. For the home equity, okay, you can deduct interest on debt to the lesser of 1 or 2 numbers, okay? Home equity, you're gonna deduct interest on debt up to the lesser of $100,000, that's the maximum, or the difference between the fair market value of the residence minus its acquisition debt. And you determine those numbers at the time you take the home equity loan out, okay?
Can you say that again, the home equity?
Yeah, it's gonna be, you can take debt up to the lesser of $100,000, that's the cap, or the fair market value of the home minus its acquisition debt. And those two figures, the fair market value and acquisition debt, are determined when you take the home equity out. We'll run through an example. You can take both of these, guys. It's not an either or proposition. You can take a mortgage interest deduction and you can take home equity interest deductions both at the same time, okay? You could potentially take, you have up to $1.1 million in debt, $1 million towards the mortgage, $100,000 towards the home equity, okay? Just a little example on how to calculate that. So let's just say I got mortgage debt, and let's say I got a big old mortgage. I got a $1.4 million mortgage. Well, the rule says I can't take interest on anything over $1 million, okay? So what you're gonna do is you're gonna take your $1 million limit over the $1.4 million loan you've got. I paid $80,000 on that 1.4, okay? You need to prorate it. So what I can deduct not $80,000, but $57,143. That would be my deductible mortgage interest. Okay, you're just prorating it down. You're capped at $1 million, but your loan is for 1.4. So you can, only take a portion of that $80,000 interest payment you actually made. Okay. Guys, like I said, general rules, our interest is not deductible, except for those 3 exceptions I talked about. So if you see something like, someone took out a car loan and deducted their interest, it doesn't qualify as a deduction. Okay, credit card interest is not deductible.
Where's the 80 came from?
The what?
The 80K?
I made it up.
Oh.
So I'm saying, look, I have a mortgage of $1.4 million, and on that mortgage this year, I paid $80,000 of interest. So it was just a made-up number. But you can't take the entire $80,000, right? Because the rules say you can only take interest on $1 million. But that 80 was on 1.4. So you have to prorate it. Okay. There's also rules out there, guys, and we'll look at these more when we get to businesses, that say you can't prepay your interest, okay? You can't prepay and take it as a deduction. They don't want you accelerating your deductions, okay? So you can't prepay. We'll look at that more when we get to businesses. I am going to run through the example on it's number 54. Okay. We have Major Healy borrowed $40,000, paid $40,000 of interest on a mortgage on his home. He borrowed $800,000 to buy this residence, and $900,000 was his original purchase price. It's currently valued at $1 million. He also has $6,000 of interest on a $120,000 home equity loan on his home. Loan proceeds were used to buy antique cars. Okay, that's okay, guys. You can take a home equity out and buy whatever you want with it. That's okay. And $10,000 of interest on a mortgage on his vacation home. Okay, so he has a second property in addition to his main property, with a loan of $200,000, and he purchased the house for $500,000. His AGI is $220,000. How much interest can he deduct? Okay. So I kind of drew this out there already. Sorry if you guys can't see it over here. He's got 3 different loans, okay? He's got 2 pieces of mortgage property. He's got his main residence, and then he has his vacation residence. And they gave us all this information. He paid interest of $40,000 on a loan of $800,000. They also gave us some other information, the adjusted basis, what he originally paid, and his fair market value to that. He's got a second home. They gave us some more information, and he has a home equity loan out. For $120,000, he paid $6,000 of interest. And guys, they told us that this home equity was taken on the main residence, okay? And that's going to become important because we're going to need to know this fair market value figure in order to figure this out, okay? So break it into parts, okay? Because we have 2 deductions here, okay? The first one, let's look at the acquisition debt. Well, our rule says we could take interest on up to $1 million worth of debt. So what's our deduction going to be? 50, right. It doesn't matter that there's 2 properties. Look, guys, as long as this doesn't go over $1 million, then he can take both of those. He's going to take the 40, he's going to take the 10. If this went over $1 million, guys, you're just going to do this exercise and prorate it down, okay? Now, in the case of the home equity, it's a little more complicated, okay? The rules say you can have debt to the lesser of $100,000. Well, we're already over that, okay? Or the fair market value of the property, okay? This home equity was taken on this first piece of property. So we're going to have $100,000 or the $1 million fair market value of the property minus its acquisition debt, okay? Minus its acquisition debt, the $800,000. This is just extra information. Don't get sidetracked by it. Okay? So this is $200,000. Well, the home equity rule says it has to be the lesser of the 2, right? So $100,000. And we're just going to go for the exercise we went through up there. He's got $100,000 over $120,000 that he actually has out, times the $6,000 interest he paid, and that works out to be $5,000. His total interest deduction, guys, is gonna be $55,000. The 2 from up here plus the 5 you calculated, okay?
Where'd the 100,000 come from again?
That's the rule you have to remember. Says that in the case of home equity, the loan, or the debt can be to the lesser of $100,000, or you have to calculate this out, okay?
I'm sorry, I'm lost. Can you after, how do you calculate that number after the 100,000?
This part here?
Yeah, a million minus 800,000.
Okay, because this is just a rule, guys. This is a rule that you have to remember for the exam, okay? In the case of the mortgage, it's very simple. It just says you can have any amount of interest on up to $1 million worth of loans. That's pretty easy. In the case of the home equity, it's a 2-part rule, and you have to look at both parts. It says that you can take debt, in the case of home equity, up to $100,000 maximum. You'll never take more than that. Or, if this is going to be smaller, you would take this. It's fair market value of the home securing the home equity, which is this home, okay, minus its acquisition debt. So you'd have to calculate that out. Obviously, guys, if this worked out to be, $85,000, let's say our numbers up here were a little different, and this was the smaller of the 2 numbers, okay, this would be, you would calculate substituting $85,000 here and change the numbers, okay? Go through both legs of the calculation. Don't just say, oh, $100,000. We tend to stick numbers in our head and then forget to do the second step. So it's not automatically just $100,000. It's the smaller of those 2 numbers. Are you guys good with this, or do you want me to go starting out?
Does this number change from year to year, or that's concrete?
No, well, I mean, they can change anything at any time, but generally this formula stays the same. I'm sure at some point they'll make a cost of living adjustment to it, but it's been the same for a while.
So if it was 85, you would still have to do that last step?
Yes, but instead of putting $100,000 here, it would be 85 over 120 times the 6, and this number would be very different.
So no matter the numbers, the last step is always, you have to enter.
You have to do it. Don't opt out. Yes, because this could very well be something smaller, and then your answer will be wrong if you default to 100. We have a habit of just saying, oh, like remembering 100, and then forgetting the rest. This example, it used this, but it could have very well been something very different.
What would happen if the debt is larger than the fair market value? Would you just get
The debt is low.
like if it's declined? None of it?
You probably end up with. They're not going to give you back a payment. I'll
Yeah,
tell you that.
that's
So
fine.
I think it's you're just going to say nothing.
Nothing.
I don't. You know what? That's a great question, and I don't know. I will bet my bottom dollar on it that there's no way they're going to refund you money. So I think you just have to say 0. You get no deduction. You guys good? Okay. Guys, please don't forget the second step. I'm saying it now. Please don't. I know we have a habit of just saying, oh, $100,000, but that's not the case. Take it the extra step, okay? Okay. That brings us to the next item on our list, which is charitable contributions, okay? Guys, the rules here generally say we can take deduction for charitable contributions up to 50% of our AGI. This is what's known, instead of as a floor limitation, this is what's called a ceiling limitation. They set a maximum amount you can take, okay? Generally, you can take up to 50% of AGI. Now guys, before you even, you're probably going to be presented with a bunch of charitable contributions. Before you even start getting into calculating anything, stop and look, okay? The first rules say that the contributions have to be made to a qualifying domestic organization. Both of those words mean something. Qualifying and domestic. Does everyone know what domestic means? Okay? It has to be for some organization within the United States, okay? If it's to the United Way of Dominican Republic, it's not going to work. That's not domestic, okay? The qualifying portion of it, they kind of go through in the book, guys, right? It's going to be educational institutions, scientific institutions. It's going to be things like museums, libraries, hospitals, Religious organizations, okay? These are gonna generally be your 501c3 guys. You guys have probably heard that term, whether or not you know much about tax, you've heard 501c3. Those are generally gonna be your not-for-profit organizations. Those are qualifying organizations. You see big things like, you know, the Humane Society, the ASPCA, the Salvation Army, you know, these big organizations, guys. Those are generally gonna be your qualifying organizations, okay? But so before you get into calculating numbers and is it this or is it that, just ask yourself, is it a qualifying domestic organization? If it's not, scratch it out immediately, okay?
What about like charities that, like the Red Cross, it's international, but I think it's mentioned here.
Yeah, they'll probably have different funds set up, but for the most part, yeah, and that's gonna work. If they're truly an international organization, they won't get really like a tax exempt status. There's different rules. But it'll be, for the most part, yes, that'll work the Red Cross.
And schools too are qualifying?
Most schools are gonna be qualifying. Guys, look, I said even like religious organizations. That doesn't mean you can go out and like start your own religion tomorrow and say, oh, I'm a religious organization, you know. You have to be qualifying. You have to apply, you have to be qualified. But for the most part, you know, your churches, your temples, your major religious organizations that we've heard of on a regular basis, those are gonna be qualifying. Rutgers is gonna be qualifying. You know, your elementary schools, things like that, they're all gonna be qualifying. They're governmental, those are all qualifying, okay?
So is there a difference between paying a tithe and like giving money? to the
I'm
church?
sorry?
So is there like a difference between paying a tithe and giving like a set aside amount of money to your church?
Well, that'll just count as a cash contribution.
Both,
Say it again.
the tithe.
What does that mean?
Like church.
Yeah, like, so you're just setting apart a certain part of your salary.
So is that considered?
It's a cash contribution. It's a cash contribution. Right, you're just you're giving them a part of your paycheck basically every week. It's a cash contribution. Okay guys, what's not qualifying, okay? Again, this may be easier to remember. Guys, political campaign contributions, those are not deductible. You can say yes, but they're to a government, but let's face it, usually you're looking for something, you're trying to curry favor, or you're trying to put someone in office. There's not usually a whole lot of charitableness going on when you're making campaign contributions. Persons in need, okay, guys, you could do a really nice thing and give someone on the street, you know, $20, okay, but he's not a qualifying organization. I know with my church, you know, every year they encourage people to adopt a family, and you know the family may put together a list of things that they would like or the kids would like for Christmas, and you may go out and purchase these things and bring them to the family. Okay, that's not going to qualify as a charitable deduction. Okay, they're not a registered qualifying organization. If I give money to my church, who then maybe goes out and buys these things, well, that's different because now I'm giving money to the church. And they're going to do with it, they're going to be a tax exempt organization and they're going to see fit how they're going to spend that money. So that would work, but me giving these things directly to the family, that's not going to qualify, okay? I know nowadays, guys, there's a lot of these websites out there, GoFundMe, I'm sure most of you have heard of GoFundMe, or like Rally.com. You may give money to a very worthy cause, maybe, you know, some child needs an operation or something of that nature. Regardless of your good intention, okay? These aren't qualifying contributions, okay? They're not gonna work. Okay. Now guys, so once you get past that saying, look, is it domestic? Is it qualifying, okay? That's your first step, don't go any further. Now, once you decide that, okay, I have a list of qualifying expenses, you have to look and say, you know, what am I giving? Am I giving cash? Or am I giving property, okay? Cash is gonna be deductible up to 50%, but property, you have to look further out, okay? Some of them are gonna be deductible up to 30%, some will be deductible up to 50%. So that's your next step, is sorting out what you're giving. Like I said, for cash, it's gonna qualify up to 50% of AGI, okay? And again, guys, we're cash basis taxpayers, so what year did I cut that check in? That's what matters. You can treat as a cash contribution, okay, any monies you spend on travel on behalf of a charitable organization, okay? So if you do some work for a charity and you're not being reimbursed for your travel expenses, you can treat them as if they were a cash contribution. For 2015, they're saying if you're using your car traveling on behalf of a charity, okay, you can deduct 14 cents a mile. If you have to stay in a hotel, again, that's going to be deductible. If you have to fly somewhere and they're not reimbursing you, it's deductible as long as you're doing it for their purposes and not your own. What you can't deduct, guys, is the value of your time. Okay, so I can offer my tax services to my church, and maybe I'm driving back and forth in my car. Well, I can't turn around and say, well, hey, I normally charge $150 an hour, and I work for you for 10 hours, so that's a $1,500 contribution plus the mileage on my car. Okay, I can't deduct that $1,500. That doesn't work. I can deduct any miles I put on my car to the tune of 14 cents a mile. Okay, so out-of-pocket costs work the value of your time. That is not going to be a charitable contribution. Okay. If you receive goods or services in exchange for your charitable contribution, okay, you can only take the difference between the check you write and the fair market value of those goods as your charitable contribution.
Can you say that?
I'm sorry?
Can you say that?
Yes. If you give money, okay, but you receive something in return, something of value in return, only the difference between the money you pay and the fair market value of what you receive back is actually the charitable contribution, not the full amount of the check you write. Guys, as you get older, as you get kids in school, you start to get invited to a lot of galas and fundraising dinners, okay? And they may charge you, $200, $500, depending on the charity, a plate, and you'll get the invitation. And they're saying it's for charity, it's $500 for the dinner. And then usually on the bottom you'll see something, fine print saying the value of this ticket is $250. So if I pay $500 to go to this dinner and they're telling me, well, the value is $250, only $250, the difference is going to actually be a charitable contribution. Again, assuming this is a qualifying charitable organization, okay? That's the idea here. You're not really giving in total a total gift. You're getting something back, and you have to deduct the cost of what you're getting back, okay? You're only giving charity to the difference.
What if like at work, for instance, you give to United Way, and let's say you donate $10, but then you win, you can win Giants tickets. Like just recently, someone won tickets to the game yesterday. So now, let's say the Giants tickets are worth $100, but you only donated 10. You have to report the other as income.
It's not. That was actually my next line item. Was that if you're entering some sort of 50-50 or raffle or something of that?
No, it's just like if you donated, you're eligible to win a prize.
In that particular case, I'm not 100% sure. I think I have to know, are they separating the one or the two? So you're saying you make this donation and then you qualify to enter this pool? Something like that, I don't know. I would think if they're directly tying your chances of winning to the amount of the contribution, then it probably wouldn't work. If they're saying, hey, you make any amount of donation and we'll enter your name into a raffle, maybe. I don't know. I think I have to know more about it.
Okay.
But the general rule is along those lines is that if you're giving to a charitable organization, but it's a sweepstakes or it's a 50-50, like my church does 50-50s around the holidays, that's not a charitable contribution. I mean, that's almost akin to a gambling expense because there's a chance you're winning something, and it could be more in line with that.
Professor, what about when you donate to ASPCA or somewhere and they give you something back, like a whatever it is, like a gift or something for making a donation?
Certain nominal gifts, you get in the mail, the little stamps that they give you, or maybe sometimes they'll send you a notepad or a
Do
t-shirt.
they deduct it though?
That's their expense, and that's considered a nominal sort of de minimis gift, so that's not going to affect it. It's more where you're getting something of real value.
Okay.
Okay? Okay, guys, so those, again, these are all sorts of cash contributions, okay? But again, the raffle tickets, the 50-50s, generally are, they're not going to be considered contributions. If you are generally going to win something as a result of this contribution, it's not going to count, okay? Your situation, I don't know. I have to know more about that. Okay, guys, so that's cash. And again, cash is deductible up to 50%. Now, guys, you might donate property, okay, instead of cash. This you have to sort into two different groups. You might be giving capital gain property, or you might be giving ordinary income property, and they each have different limits, okay? Capital gain property, guys, you can deduct the fair market value of that property at the time you make the donation. So you look at the fair market value when you're making a donation, and the capital gain property is deductible only up to 30% of AGI, okay? 30% of AGI. And what is capital gain property? All right, we've talked a bit about capital gains, okay, guys? For purposes of charitable contributions, it's appreciated property, okay? Property that you've held and has gone up in value, okay? Appreciated property that you've held for more than a year, okay? It has to have gone up in value. You have to have held it long-term, more than a year, okay? And then the rules go on to say, guys, that this is the type of property where if you had sold it instead of donating it, it would have resulted in a capital gain to you, okay? So for the most part, guys, these are going to be our personal and our investment assets, right? Thinking back to code section 1221, personal and investment assets. Gone up in value and you held it long term. Okay, guys, I'm going to stop. There's a tax planning opportunity here, okay? The code says that if you donate appreciated property, you don't have to pay the capital gains on it, okay? So let's say I wanted to make a donation to my church, okay? And I have $50,000 of cash, and I'm thinking about giving it to them. But then, you know, I'm stopping and looking and saying, wait, I've got some stock that I bought a bunch of years ago. And I bought the stock for $5,000, and it's worth $50,000 right now, okay? The rule says that if I take this property and donate it to the church, I can take a 30% deduction for the value of the property, the $50,000, and even better, I don't have to recognize the $45,000 capital gains, right? I'm giving away something worth $50 with a basis of 5, right? Under Rule 1001, you would take the $50,000 minus the 5. In other circumstances, I would have to take a $45,000 gain into gross income. I don't have to do that, okay? If I give this property, this appreciated property to charity, I don't have to report gross income. So in a case like that, it may be better to give an appreciated piece of property instead of cash, okay? But hang on to that thought for a second, because you're going to see where it may come back to bite you. Okay. So, with the capital gains property, we're still on capital gains, okay? There's a limitation, okay? It says if you donate tangible personal property, tangible, right guys? Touch, feel, okay? So no stocks, no bonds, anything of that nature. Tangible personal property, okay, to a charitable organization. And the organization uses it for reasons unrelated to their charity, okay? They use it for reasons unrelated to the purpose of their charity, okay? Then you can't deduct up to the fair market value. You can only deduct the adjusted basis. So if I gave them that stock, well, the stock wouldn't work. But let's say that I gave them a car instead. Well, then instead of being able to deduct 30% of my $50,000, okay, I would only be able to deduct 50% of my $5,000 adjusted basis. So that really changes things, okay? If I give them a piece of property, tangible, personal piece of property, with an appreciated value, and they turn around and use it for something unrelated to their cause, okay, the level of my deduction changes. I can't deduct fair market value, I deduct adjusted basis, and to the extent of 50%, not 30.
How are you to know that they're not going to just?
Well, the rule kind of says, look, you have to have knowledge, okay? You know that they're probably, that you know either flat out that they're going to turn around and sell it, or, here, I'll give you 2 examples, all right? I donate a car that's appreciated in value, to a museum because they're having a car show. Okay, well that makes sense, right? I'm giving them a piece of capital gains property that they're using for a purpose related to their cause. They're going to show this car as part of their exhibition, okay? That's going to work. But let's just say I take that car and instead give it to my church, okay? What is the church going to do with the car? I have to have pretty good knowledge that the church really has no need of an antique car. What are they going to do? They're going to sell it for the cash, okay? They're a tax-exempt organization, so they don't have to recognize the profit on it. And I don't have to recognize the profit, right, under the rule I just told you. But you do, because this is where I'm giving a tangible piece of personal property, and they're using it for an unrelated cause, okay?
But if they were using that card to like take food to a food bank or something.
If they were gonna use it for their cause, then absolutely, then it would qualify. But the point is look, if you're just giving them something to avoid recognizing this appreciation, having to avoid recognizing the gross income, and you know very well that they're not gonna use it, or you have a really good idea that they can't use it, then you're not allowed to do that. Then you have to take adjusted basis up to 50% instead of fair market value at 30. Okay? Guys, it's confusing, it's in the book, go back and look at it, because I know those, that's a lot of stuff thrown at you. Okay? Yes?
Could you say again what happens with the deduction when you donate the card to like the antique museum?
That's gonna work, right? Because now I'm giving them a capital gains piece of property, an appreciated piece of property, and they're using it for their causes. So in that case, I would be able to deduct the fair market value at 30% of my AGI. As long as it works, then it's fine. Then there's no change to the rule for capital gains. Capital gains rule is fair market value up to 30% of AGI.
Another one's 50% of the
Adjusted basis, right? If I fail, if I give them a piece of tangible personal property, but they're not going to use it for their purposes, well then it goes back to adjusted basis at 50%.
Okay, thank you.
Okay? Okay, guys, so that's capital gains property. Okay? Ordinary income property, guys, is everything that is not capital gains property. Okay? It is property that has depreciated in value. Okay? Gone down in value since you've owned it. Okay? It is property that you've held short term. Guys, it's things like inventory and accounts receivable, right? 1221 said everything is a capital asset except for certain items. Well, if I give them inventory, if I give them my accounts receivable, that's going to be ordinary income property because it doesn't meet the capital asset definition, and therefore I could never get capital gains on it, okay? This is the type of stuff you're looking out for in ordinary, okay? The rules for ordinary, guys, say you deduct it to the lesser of the fair market value or the adjusted basis. You pick the smaller of the two. And you can deduct it up to 50%. Okay, 2 last notes and then we'll work through a problem. Guys, if your contributions are capped by these 50 or 30% limitations, the rules say you can carry them forward for 5 years, okay? If you're capped, and we'll do an example where we get capped, you can carry the balance forward, hopefully for deduction within the next 5 years. You can use it on your future tax returns, okay? And I will point out for you guys personally, the book kind of sorts these into 2 sets of rules, 50-30 rules, and then 30-20 rules for non-operating foundations, private non-operating foundations. Don't worry about the non-operating rules, okay? I just want you guys to know the general private foundation rules. Okay, so worry about the 50-30 rules. Don't worry about the 30-20 rules. If you're confused by that, let me know. Okay, so let's look at problem number 56. Did anyone have a question? I feel like I saw it.
So we don't have to worry, we're not going to be in a problem where it's like a non-operating.
No, I'll stick with the general set of rules, the 50-30 rules. Okay. It's the same rules, the percentages just change. So if you guys know the one set, then that's good enough for me. Okay, so problem number 56. Yes. Okay, we have Calvin. He reviewed his canceled checks and receipts this year for charitable contributions. He has owned the IBM stock and painting since 2005. Okay, so he's held them long term is what they're telling us. Calculate his charitable contribution deduction and carryover under the following circumstances. Okay. So here we are. Here's Calvin's information. These are the contributions he's made during the year. Okay, guys, what do you want to do first before you go any further?
Cross out the ones that are in the
Exactly. Take off anything that's not domestic, it's not qualified, okay? The family in need, guys, it was a very nice thing of Calvin to do, okay? But it's not going to qualify for tax return purposes, so get it off your list, okay? Now you are down to qualifying contributions, okay?
CW.
Sorry, United Way, I abbreviated with some of them. I think it's United Way. Okay, so now what you want to do, guys, is go through property by property and label it. Figure out, did I give cash? Did I give property? If it's property, you know, go through the characteristics. Is it a 30% limitation or is it a 50% limitation under the ordinary income law? Okay? So you go through property by property. You gave to a hospital, you gave them some stock. Okay? We know, okay, they told us in the problem that these were held long term. So, and this stock is appreciated in value. Okay, guys? So this is going to be a capital gain property. Okay? We know capital gain property is deductible up to a 30% AGI limitation. The rules for capital gains, guys, say you use the fair market value. So that is going to be the amount I'm going to try to deduct, up to 30%. Okay? Museum, painting, bought it for $5, it's worth $3 now. Okay? It's going to fail the capital gain test because it has gone down in value. It's depreciated. So it's going to become ordinary income property. Ordinary income property is deductible up to 50% of AGI. And you pick, in the case of ordinary income, the lesser of the two. Okay? Here is going to be my fair market value. Okay? Guys, cash is cash. Okay? And it gets deducted up to 50%. Okay? Good so far? Now, here's the way I do it. The book might go about it in a slightly different way. Do it however it gets you to the right answer, but this is what I do. Okay? In Part A, they tell us the taxpayer has AGI of $100,000. Well, I know I can deduct my contributions up to 50 and 30%. So I will take that AGI and I will take 50% of it, which is $50,000. Okay? Or 30%, which is $30,000. Okay? Those are my limitations. I cannot, no matter what, on my tax return, take a dime of a deduction more than $50,000. Okay? I cannot go over this number. This is my absolute drop dead cap for this charitable contribution deduction. Okay? The rules then say use your ordinary income, your 50% first. Okay? Use them up first. So I'm going to take my cash first. I'm eligible to claim up to 50. I only made cash of 8, so I still got plenty of room in there. I still got $42,000 I can use. Okay? So I'm going to pull in my $3,000 for the painting next. Okay? So of my 50%, I've used 11. Okay? This leaves me with a balance of 39. I still have to account for this property though. Okay? I gave away a 30% property to the tune of $22,000. So I'm going to put it under here. Okay. Well, there's not a big problem right now, okay? Because the $22,000 is smaller than its cap, okay? For these types of property, I couldn't give more than this in total, but I didn't. And it still fits in with my maximum cap of 50, okay? So my contributions here, guys, will be 8, they'll be 3, and they'll be 22, okay? So I would have given away $33,000. That would be my Schedule A deduction, okay? Does everyone get it, or you want me to? Good. Okay. Part B.
I do have a question. Why is it 3,000 and 8,000? Why is it not the 50%?
Well, these are the 50% properties. No. You can give these amounts away up to a limitation of 50% of your AGI.
Okay.
So 50% of my AGI is $50,000, which is I'm saying I can't take as a deduction anything bigger than this number.
Okay.
But so far I've only given away 8 and 3, so I'm good. Okay. Okay, so we did Part A. Part B, guys, says Calvin's AGI is still $100,000, but the State Museum, okay, the museum where he gave the painting, told Calvin that it plans to sell the painting, so they're not going to use it for their purposes. Okay, does that matter? Does it? Why not?
Because the market value is down, I think,
You're on the right lines. It doesn't matter in this case because it's ordinary income property. Okay? So yes, the value went down, therefore it's ordinary income property. Okay? Those rules apply for capital gains purposes. If it was a capital gains property and they did that, then the rules would change. Then he would have to take the adjusted basis at 50%. Okay? But it's an ordinary income property, so it doesn't matter. Okay? It doesn't change the answer that we calculated in Part A. Okay, C, Calvin's AGI is $50,000. So I'm going to do the same thing. 50% is, give myself more room now. Okay, so set your limits first. Okay, we have the same contributions. Again, you take your 50%ers first. I have $25,000 cap. I have $8,000 in 50% contributions that I made. So they'll work. That's good. I can take those. That's going to leave me with a maximum eligible contribution of $14,000 that I can still make, right? Because I can't take anything more than that number. I've already used 11, so I've only got 14 to go. Okay? I haven't accounted for this yet, though. I have a $22,000 piece of property. Okay? But first, guys, I'm stopped by this. Okay? For these types of 30% capital gains properties, I can't contribute more than the cap. Okay? So I can't take 22 this year. The most I could take right now is 15. Right? With me? Okay, so I can't take 22. I can carry it forward though, it's not lost. Okay? But if I took 15 plus these 11, that would be 26, right? Can't do that. I can't go over this number. Okay? So, yes, this is capped by this, but this, guys, you further have to look to see what's my balance available here. Okay? So I can't take this 15 either. I have to use this 14 up. Because 8 plus 3 and 14 would make me 25. If I tried to take the extra $1,000, it would put me over my total 50% cap. I can't do that. So what I can take is 8, 3, and 14. I could take $25,000 this year. Okay? And my other $8,000, I'm going to carry forward for 5 years. Is everyone with me on the numbers? Is where everything's coming from? Okay, and by the way, we carry it forward as 30% property. So next year you would put it under that category. Is everyone good with the numbers, guys? If you don't get it, please stop me.
I think 5 years?
That's just the rule. They just say you can carry it forward for 5 years. So hopefully you can use it next year. If you can't, you can use it the year after, up to 5 years. After that, it goes away. It's gone. We good, guys? All right. I'm not going to do the last part. Okay. This is what you have to look for, guys, right? Look for qualifying. Look for domestic. Sort it into the different properties. Okay, cash, 50%, capital gains, has it appreciated? Have I held it for a year? Be careful of that sort of tricky rule with the tangible personal property for unrelated purposes. If it is, the rule changes, okay? And then everything else is ordinary income property, deductible to 50%. Set yourself up with your limitations, okay? Make sure you stop. Make sure you don't in total go over that number. You start with your 50%. Then you try to add your 30% to whatever availability is left.
You say that 50% was like 20, and we saw that 50,000 now it's only 15, right?
If this was 20, I used up 20 here. That means there's only $5,000
But if the
left.
balance was 20.
Oh, if this was 20.
Yeah.
So this is now 20. That would mean, yes, I could take 20 of this, and I would have a $2,000 carry forward. Wait, am I answering your question?
Even though there's a $15,000
Wait.
cap on that times 10?
All right, wait a minute, let's make sure I do this the right way. So you're saying there's 20 left here. We're only took 5. Okay, no. I took 5, so now I have a balance of 20 here. Now I have this $22,000 piece of property. No, I cannot ever take more than that number with those properties. So I would take the 5 and I would take the 15. Even though there's still money available in here, no, because this is first limited by that. Then this is further limited by that. So no.
How'd you get the 8,000? Like, how'd you decide that was the carry forward?
Okay, because in total I have $33,000 I'm accounting for, right? 22, 3, this would be 33 total, those 3 pieces of property. I used up my 8 and my 5. That's 11. Going back to the other one. Right, and I said this is capped by this, but then this is capped by that, this is smaller. So I'm using up all 25. So 25 minus the 33 I contributed is, the difference is 8.
Yeah, it was 33.
This, 33, sorry, 33. That's right, 33. Minus 25 is 8. 33 is the $22,000 fair market value here.
Okay, all
The $3,000 here, and then the $8,000 in cash. That's $33,000 minus the 25 I'm giving away or deducting, which means I still have $8,000 that I didn't use this year, or I'm not eligible to use this year. So I'm going to carry that forward. Okay, you guys with me on the numbers? Okay. Did the part we did with Natalie make sense to everyone? Okay, did you guys catch that? Okay, all right. Okay, guys. Next up on our list is casualty and theft losses. Okay, guys, if you look at the schedule here, okay, these particular casualty and theft losses are related to personal use assets. Okay, you would report casualty and theft losses on investments as a below-the-line miscellaneous itemized deductions. For trade or business, you report them on your Schedule C. So this particular category we're working on right now is for personal losses, okay? Personal use assets. There's a separate line below, which we're not going to cover in detail, but I'll point out when we get to it, for investments, okay? Okay, guys, so we said typically if you have a personal use asset, right, you're not allowed to take the loss. There's only very limited situations under Code Section 165. Those related to your trade or business, those entered into for profit or casualty and theft losses, okay? This is that third exception right here, okay? Now, a casualty or a theft loss, guys, is defined as something sudden, unexpected, or unusual. Sudden, unexpected, unusual, okay? So there's lots of court cases in this area. Things like termite damage to your home, it's not sudden, okay? It happens over the course of time. Erosion at a beach house, that's not sudden. It's something that's happening over the course of time. There's a lot of court cases about cracking foundations out in places like Arizona. It's not sudden, okay? It has to be sudden, unusual. Typically, they're saying things like storm, fire. They include shipwreck, which I'm not sure how often that happens, but they have it listed specifically in the code. You know, guys, it could be something as crazy as a plane lands in your house and your house is totaled, okay? It's sudden, unexpected, unusual, okay? What it doesn't include, guys, and this is not in the book, so again, pay attention, okay? Misplaced, I misplaced it, I lost it, can't find it. Or broken, okay? The dog broke it, okay? Those don't count as casualty and theft losses. Those are insurance claims, but they are not deductible on your tax return, okay? You file insurance, but you can't take them here, okay?
So in areas like Florida, you're not able to do it.
In a lot of cases, it depends on like where you're, if you're right on the coast and it's a, you know, a hurricane, no, because it's right, it's not unusual, unexpected. You kind of know it's coming. So, no. Sudden, unusual, unexpected, okay? Okay, again, guys, you deduct it, okay? As far as casualty losses in the year they occur, theft, they say you deduct when you learn of it, okay? Sometimes we don't know things are missing until we go looking for them, okay? So theft, you can actually just, it doesn't have to be in the year it happened, it's when you discover it. That's what the rules say.
Professor,
Yes.
in case of an earthquake, apply.
That's more sudden and unusual. I don't think they're gonna have too much of a hard time with that. Something like even like, you know, Sandy last year, all those houses down, you know, along the shore got wiped out. Yes, they are coastal homes, but we don't have flooding that bad here on a regular occurrence. That was something pretty unusual. I think everybody would agree. So like those houses will be able to make these claims. You know, my basement flooded not during Sandy, but it was the year before, I think, in Irene, I think it was. Like that would be something sudden and unusual and unexpected. We had gotten like a ton of rain and a lot of people's basements flooded. I would be able to deduct that. Okay, guys, so the rules go on and say, look, you can deduct these losses after you take out any reimbursements, right? You have an insurance claim, you have to reduce any expenses you have by that amount first. You always have to take out the reimbursements, okay? Then you have to look at your amount of your loss, and your amount of your loss is the lesser of, okay, two options here, the lesser of the adjusted basis that you have in the asset, or the decrease in the fair market value, okay? What was the fair market value of the asset before the casualty or theft, and what's its fair market value after the casualty or theft? You have to pick the lesser of those two figures. Then there's two more limitations. You're not done, okay? They say per incident, you have to first deduct $100 for each incident. So you might have, you know, your house flood this year, okay, and you have some sort of expenses, deduct $100 from that, and maybe your car got stolen, okay? Well, figure out your losses there and deduct $100. Anything that's remaining, you add together, and it's subject to a 10% AGI floor combined, okay? We'll do an example. But those are the limitations. This has got a weird, quirky $100 limitation first per incident, and then a group 10% AGI limitation. Okay, problem number 58. Okay, we have Tim. He suffered greatly this year. In January, a freak storm damaged his sailboat, and in July, his motorcycle was stolen. And then they give us some information, and they tell us how much money he makes. Okay, so there we go. Can you guys see if I do this here? Can you guys see? Okay. So we have Tim. He's got an AGI of $50,000. Okay, and he has a boat which suffered an accident, and he has a motorcycle which was stolen. Okay, and they tell us that the boat has a $27,000 adjusted basis. They tell us he made $6,200 of repairs to the boat, and he got back insurance of $1,000. For the motorcycle, this is his adjusted basis, and they give us the fair market value of the bike before it was stolen. Okay?
What's it say next to book?
That's supposed to be accident. You can't read my shorthand? Okay, so you have to look at the numbers, okay? First, you have to figure out what's my loss for each one. Okay, again, it's the lesser of the adjusted basis or the decrease in fair market value. Guys, if they give you the repairs, think about it this way, okay? This bike might have been worth $20,000 before it got in the accident, okay? It probably dropped to a worth of $13,800, and he paid to have it repaired and restored back to where it was before the accident. So the repairs really just represent the decline in the fair market value. It's just he's already had it restored, okay? And it cost him $6,200 to do that. So this represents the decrease in fair market value. So of these two numbers, I have to pick the smaller, okay? So here, this is my starting point. Now in the case of the motorcycle, again, the lesser of the adjusted basis or the decrease in fair market value. Guys, this motorcycle is now gone, okay? So after the accident, it has no fair market value to him anymore, okay? So the decrease there is $17,000, okay? $17,000 decrease versus the $15,500 adjusted basis. I'm going to pick that number. Are we good so far?
Yeah.
Then go through your calculations. So $6,200 in expenses minus insurance money. Gotta take the insurance money off first, okay? It's $5,200. And I have a per incident charge of $100. Don't forget that. So I potentially have a loss of $5,100 for the boat. For the motorcycle, $15,500. I have no insurance. Okay, at least they didn't tell me I did. Again, I have to take off $100. That's just a rule. Okay? So after I take off the $100 per incident charge, I have each of these. Add them together. It's $20,500 combined. Okay? Now I apply my 10% floor. Okay? He has AGI of $50,000 times 10%. I have a $5,000 floor. The first $5,000 is not deductible. Only what expenses go beyond that number are deductible. We good? Don't forget the 100, guys. Everyone leaves the 100 out. Okay? That $100 is really meant to throw away like small claims. Like I lost my iPhone and I have to replace it. And they don't want you submitting every little claim. So by putting that $100 in, they're trying to throw away, you from turning in every little claim you've got. So you take the $100 off each, you apply the floor to what's remaining. Guys, okay, just be careful on problems. A lot of times, people forget to factor in the insurance. And a lot of times insurance policies are written so that, you're gonna get the replacement value, you're gonna get the fair market value of whatever was stolen. So if this bike had a $17,000 insurance policy, it said we're gonna give you fair market value if something happens to it, okay? I'd have no claim here because my insurance would be bigger than this number. And I can't take a negative claim, okay? If my insurance is bigger than this number, I have no claim to make. Was it $1,500? There's no claim there, okay? So forget it in that case. If I get back insurance more than the amount of my loss, you can't claim it. So just be careful. All right, guys. We will finish this up on Thursday. We'll get into IRAs. We have a quiz next Tuesday on Chapter 6, and I'm hoping Chapter 13. So we'll see how far we get on Thursday. My goal is to get through IRAs at least. We may not get to the investment expense in Chapter 7 until